In 1957, an insurance company in London added a sentence to its contracts. It was not controversial. Nobody objected, nobody priced it, and for the next 35 years, it cost nothing at all. That sentence destroyed the oldest mutual insurer in the world. Not a fraud, not a rogue trader, not a run, not a bubble. No one stole anything. The Equitable Life Assurance Society was killed by a promise it had made in good faith to its own members and then could not keep. And the mechanism that killed it is sitting inside a great many institutions today, invisible for exactly the same reason it was invisible then. This is the story of a guarantee that looked free. Start with what Equitable Life actually was, because it was not an ordinary company, and the difference matters enormously to what happened. It was founded in 1760. That makes it older than the United States, older than the Bank of England's banknote monopoly, older than the Industrial Revolution it would go on to insure. It was the first insurer anywhere to price life assurance using actual mortality tables rather than guesswork. The first to work out, statistically, how long people were likely to live and to charge accordingly. That sounds obvious now. It was revolutionary then. Before Equitable, life insurance was closer to gambling, a flat premium regardless of age, which meant the young subsidized the old and the whole thing collapsed whenever the age mix shifted. Equitable's founders applied mathematics to it, and in doing so, invented the modern actuarial profession. So this was not a fringe operation. This was the institution that taught the industry how to do the arithmetic. And it was a mutual, which is the second thing to understand. A mutual has no shareholders. The policyholders own it. There is no external capital, no share issue to fall back on, no parent company to inject funds. Every pound of surplus belongs to the members, and every pound of loss comes out of the members. That structure was, for 2 centuries, the source of its strength. No shareholders meant no dividends leaking out, no pressure for quarterly results, no conflict between the owners of the company and its customers, because they were the same people. It was also, in the end, the reason there was nobody to catch it when it fell. Now the guarantee itself, which requires understanding a specific piece of pension machinery. If you were saving for retirement through a with-profits pension in the middle of the 20th century, you paid in over your working life, and at the end you converted your accumulated fund into an annuity, an income for life. The rate at which that conversion happened determined your pension. A better annuity rate meant more income from the same pot. Annuity rates move with interest rates and with life expectancy. If rates are high and people die relatively young, an insurer can afford to pay generously. If rates fall and people live longer, the same pot buys much less. What Equitable added in the late 1950s was a guaranteed annuity rate, a floor. Whatever happens to interest rates between now and your retirement, we will convert your fund at no worse than this specified rate. Read that again with the benefit of hindsight, and it should look alarming. It is an open-ended promise about conditions decades in the future, made by an institution with no shareholder capital and given away without an explicit charge. At the time, it looked like nothing. Here is why it looked like nothing, and this is the part that generalizes far beyond one insurer. In the late 1950s and through the 1960s and 1970s and most of the 1980s, market interest rates were comfortably above the guaranteed level. The guarantee was written at rates that seemed conservative. actual annuity rates available were better, so the floor never bound. Every policyholder retiring took the market rate because the market rate was higher and the guarantee sat there unused. A promise that never has to be honored has no visible cost. It does not appear as an expense. It generates no cash outflow. In the accounting of the day, it barely appeared at all. And it had a genuine commercial benefit. It was a selling point. It made the product more attractive than a competitor's without apparently costing anything. Other insurers offered similar guarantees for the same reason. Then came the thing nobody planned for, which was not a crash. Inflation fell. Through the 1990s, across the developed world, inflation came down and stayed down, and with it came a long decline in interest rates. That is generally regarded as one of the great economic achievements of the period, and for most purposes, it was. For anyone who had guaranteed an annuity rate in 1957, it was a slow-motion catastrophe. Because, as market rates fell below the guaranteed level, the floor started to bind. Suddenly, the guarantee was not a decoration. It was a live obligation to pay pensions at rates the company could no longer earn. And at the same time, the second variable moved against them too. People were living longer, significantly longer than the tables assumed when the guarantees were written. An annuity is a promise to pay until death. Every additional year of average life expectancy makes every annuity more expensive. So both halves of the calculation deteriorated simultaneously for a reason that was nobody's fault and that no one could reverse. By the late 1990s, Equitable Life had a problem it could not price its way out of. Roughly 90,000 policyholders held guaranteed annuity rates. The cost of honoring them in full ran to well over £1 billion, and there were no shareholders to ask. Which brings us to the decision that turned a financial problem into an existential one. The board's response was ingenious, and it was the beginning of the end. They did not refuse to honor the guarantees. Refusing outright would plainly have been a breach of contract. Instead, they used the one lever A with profits fund gives its directors the terminal bonus. A with profits policy has two parts. There is the guaranteed sum, which accrues over the years and cannot be taken away. And there is a final or terminal bonus, awarded at the point the policy matures at the discretion of the directors, reflecting how the underlying investments have performed. That discretion is real and it is necessary. It is what allows a with-profits fund to smooth returns across good years and bad. It is not, in itself, a loophole. Equitable used it as one. Policyholders who exercised their guaranteed annuity rate were awarded a smaller terminal bonus than policyholders who took the market rate instead. The logic was that the guarantee and the bonus were two forms of the same thing, a share of the fund, and it was only fair that someone taking a valuable guarantee should take a correspondingly smaller share elsewhere. Otherwise, the argument went, the guaranteed policyholders would be subsidized by everybody else. The effect was that the guarantee, in practice, was worth very little. You could have the rate you had been promised, or you could have your bonus, but not both. Which raises the obvious question, and it is the question that went to court: is a guarantee you are penalized for using a guarantee at all? The case is Equitable, Life Assurance Society against Hyman, and it is one of the most consequential pieces of British financial litigation of the last century. Equitable itself brought the action. That is worth pausing on. The society went to court seeking a declaration that its differential bonus policy was lawful. It wanted certainty, and it expected to win. It had legal advice that the director's discretion over terminal bonuses was effectively unfettered. At first instance, it did win. The High Court found for the society. The Court of Appeal reversed that, and in July 2000, the case reached the House of Lords, then the highest court in the land. The Lords were unanimous, and their reasoning is the heart of this story. They accepted that the directors had a broad discretion over terminal bonuses. That was not in dispute. What they held was that the discretion could not lawfully be exercised in a way that defeated the very guarantee the society had given. A power conferred for one purpose cannot be used to nullify a promise made elsewhere in the same contract. Lord Steyn put it in terms of what the reasonable policyholder would have understood. Someone reading their contract would understand the guarantee to be worth something. A discretion exercised specifically to cancel out its value could not be what the parties had agreed. The society lost. The guarantees had to be honored in full, and the terminal bonuses paid alongside them. The bill was around £1.5 billion. Now consider what a mutual with no shareholders does when handed a bill of that size. There is no rights issue because there are no shares, there is no parent company, there is no external capital of any kind. There is only the fund, which belongs to the policyholders, all of them, including the ones with no guarantee at all. So the cost fell on the membership. The people who had to pay for the guarantees were, in large part, people who did not have them. 8 days after the House of Lords ruling, Equitable Life closed to new business. It tried first to sell itself. The sale process failed once the scale of the liability was clear, because a buyer would have been buying the liability. With no new premiums coming in, a closed fund can only shrink. Then came the part that hurt most, and it is the part people still talk about. The society cut policy values. In July 2001, it applied a reduction of 16% to with-profits policy values, a straightforward write-down of what people believed they had saved. It imposed heavy exit penalties on anyone trying to leave. Around 1 million policyholders were affected in one form or another. These were not speculators. They were teachers, doctors, civil servants, and a very large number of self-employed professionals, because Equitable had been particularly strong in the market for individual pensions among the professions. It had a reputation for probity that stretched back 2 centuries, and low charges, which is precisely why careful people chose it. The people most exposed to this were, by and large, the people who had been most prudent. Then the question of who was supposed to have noticed. The government commissioned an inquiry under Lord Penrose, which reported in 2004, and its conclusions were uncomfortable for almost everyone involved. Penrose found that Equitable had been paying out more than it was earning for years, distributing bonuses that its actual investment returns did not support, so that the fund was progressively weakened long before the annuity guarantee crystallized. The society had, in his phrase, been the author of its own misfortunes. The guarantee was the trigger, not the underlying cause. He was also critical of the regulators and responsibility for insurance supervision had moved between departments over the relevant period, and the reporting regime did not require the guarantees to be shown in a way that made their potential cost visible. Nobody was looking at the right number, partly because the right number was not required to be published. A separate report by the Parliamentary Ombudsman went further, finding serial regulatory maladministration and recommending compensation. It took until 2010 for a compensation scheme to be established, and its scale was significantly smaller than policyholders had hoped. Many were, by then, elderly. Some had died waiting. Lay! So what actually went wrong here in mechanical terms? Because this is the part worth taking away. The first thing is that the guarantee was never priced. No explicit charge was made for it. No reserve was set aside against it. It was given away because, at the moment of giving, it appeared to cost nothing, and an obligation that costs nothing today can be enormous tomorrow if the conditions that made it free happen to change. The second is that the cost was invisible in the accounts for decades. This is not the same as being hidden. Nobody concealed it. The reporting conventions of the time simply did not require an insurer to state what its guarantees might cost under adverse conditions, so the number was not calculated, so nobody knew it. The third is that the trigger was not a disaster. It was a benign development. Falling inflation and rising life expectancy are both unambiguously good things. The institution was destroyed by good news arriving in a form its contracts had not anticipated. That is what makes this mechanism so much more dangerous than fraud. Fraud has a perpetrator, and perpetrators can be caught. This had no perpetrator. Every individual decision along the way was defensible, taken by competent people acting in good faith, and the aggregate was fatal. There is a fourth element, and it is structural. A mutual has no shock absorber. In a shareholder-owned insurer, a loss of this kind falls first on the shareholders. That is what shareholder capital is for. It sits between the liability and the customers. Equitable had no such layer. The membership was simultaneously the owner and the customer, so a loss to the company was immediately and directly a loss to the very people the company existed to serve. Mutuality had been the society's great virtue for 238 years. It became, in the space of a fortnight, the reason there was no one else to absorb the blow. It is worth being clear about what this episode did and did not prove, because it is often enlisted in arguments it does not really support. It did not prove that mutuals are inherently unsound. Plenty of mutuals have survived far worse and are still trading. It did not prove that guarantees are inherently reckless. Guarantees are the product in a great deal of insurance, and pricing them correctly is a solved problem. What it proved is narrower and more useful. An institution can be destroyed by an obligation that generates no cost, no cash flow, and no accounting entry for the entire period during which it is accumulating. The danger is not the promise. The danger is a promise nobody is required to measure. And that is not a historical curiosity, it is a live category. Defined. Benefit pension schemes across British industry carry exactly this shape of risk, a promise made decades ago against assumptions about returns and longevity that have since moved, sitting on the balance sheet of a company whose current business has nothing to do with it. Several substantial British firms now have pension liabilities larger than their market capitalization. The promise was cheap when made and is not cheap now. Long-dated private finance contracts have the same structure. So does any commitment where the payer's obligation is fixed and the underlying cost is not. The tell in every case is the same. Look for an obligation that has been given away without an explicit price attached, whose cost depends on a variable outside anyone's control, and which does not currently appear in the accounts because it does not currently bind. Every one of those conditions was true of the guaranteed annuity rate in 1957 and remained true for 35 years. It is worth walking through the numbers because the scale is what makes the mechanism vivid. When the guarantees were written, a typical guaranteed annuity rate might convert a pension fund at something in the region of 11%. That is, for every £100,000 accumulated, an income of around £11,000 a year for life. In the 1950s, that looked cautious, because market rates were higher and the guarantee would simply never be reached. By the late 1990s, the equivalent market annuity rate had fallen to roughly half that. So a policyholder with a guarantee was entitled to an income around twice what the same fund could actually purchase. Double, not a marginal advantage, a doubling, funded from a pool that had not set aside a penny against it. And the guarantees were concentrated. Around 90,000 policyholders held them, out of a membership approaching 1 million. So a tenth of the members held a claim that, if honored in full, would consume a substantial fraction of the entire fund. That concentration is the reason the board reached for the terminal bonus in the first place. From where they sat, the alternative looked like 900,000 people paying for 90,000. Their solution was found to be unlawful, and rightly, but the problem they were trying to solve was real, and it had been created 40 years earlier by people who were no longer there. Now, the longevity side, which gets less attention and did comparable damage. When the annuity tables underlying those guarantees were constructed, a man retiring at 65 in Britain could expect to live roughly another 12 years. By the end of the century, that had risen to something closer to 17, and it has risen further since. An annuity is a promise to pay until death. 5 additional years of average life expectancy is not a 5% increase in cost. On a payment stream of that length, it is closer to 40%, and it applies to every single policy simultaneously. Insurers call this longevity risk, and the modern industry prices it explicitly, hedges it, and reserves against it. In 1957, it was not that it was mispriced. It was that it was not conceived of as a risk at all. Life expectancy had improved gradually and predictably for a century. There was no reason to imagine it would accelerate. So the two variables that determine the cost of the guarantee both moved adversely at the same time, for entirely unrelated reasons. One monetary, one medical, and neither had anything to do with how well the society was managed. There is a broader point buried in that which is worth stating plainly. Financial institutions are generally destroyed by things they were watching. A bank run is visible, a rogue trader is a person. A bubble is discussed in the newspapers for years before it bursts. In each case, the institution can at least be criticized for failing to act on information it had. Equitable was destroyed by two trends that were the subject of universal public celebration. Lower inflation and longer lives were the stated goals of government policy across the entire period. Nobody was going to warn an insurer about them because nobody classified them as dangers. Which brings us to the regulators and to a question that recurs whenever an institution fails. The supervisory regime for insurance in Britain over the relevant decades was, by modern standards, thin. responsibility moved between the Department of Trade and Industry, the Treasury, and eventually the Financial Services Authority. Each handover involved a loss of institutional memory, and none of the successive regimes required an insurer to disclose the potential cost of its guarantees under adverse conditions. That last point is the substantive one. The regulators did not miss a number that was sitting in front of them. The number did not exist because nothing required it to be computed. Supervision consisted largely of confirming that the society met its statutory solvency margin, a calculation which, as constructed at the time, did not capture a guarantee that was not currently binding. Penrose was critical of this, and the parliamentary ombudsman more so, finding maladministration across multiple departments over more than a decade. But the criticism is not that officials were idle, it is that the entire reporting framework was built to answer a different question from the one that mattered. That is a failure of design rather than diligence, and it is a good deal harder to fix because you cannot design a disclosure regime around a risk nobody has yet identified as one. There is one more strand, and it is the one Penrose treated as the underlying cause rather than the trigger. For years before the guarantees crystallized, Equitable had been distributing more than it earned. A with-profits fund is meant to hold back surplus in strong years to support payouts in weak ones. That smoothing is the entire proposition. Equitable ran the policy unusually thin, declaring bonuses that its investment returns did not fully justify on the working assumption that future returns would make up the difference. That practice had a competitive logic. Published bonus rates were how with-profits funds were compared, and a fund declaring higher bonuses attracted more business. It also had a mutual logic. With no shareholders, the members were entitled to the surplus, and holding large reserves could be characterized as withholding members' own money from them. The consequence was a fund with very little spare capital at the precise moment it needed a great deal. Penrose's judgment was that this, more than the guarantee itself, is what made the society fragile. A better reserved insurer facing the same annuity liability would have been damaged. Equitable was destroyed. Several other British insurers had written comparable guarantees. Most survived because most had capital behind them, either shareholders or a more conservative bonus policy, or both. The guarantee was an industry-wide problem. Only one institution died of it. That comparison is the closest thing to a controlled experiment this episode offers, and it points firmly at reserving rather than at the promise. It is worth being precise about the human consequences too, because it is easy to discuss this as a balance sheet event. The 16% cut applied in July 2001 was not a paper adjustment. It reduced the value of the savings of people who were, in many cases, within a few years of retiring and who therefore had no time left to rebuild. Exit penalties meant that leaving to limit further losses cost money in itself. Policyholders found themselves choosing between two bad outcomes with no good one available. Equitable had been particularly strong among the professions, doctors, lawyers, academics, and a large number of the self-employed, for whom this was the whole of the pension provision rather than a supplement to an employer's scheme. The society's low charges and two-century reputation were exactly why careful, financially literate people had chosen it. There is no reading of this in which the victims were imprudent. The opposite is closer to the truth. The compensation story that followed took another decade. The Parliamentary Ombudsman reported in 2008 and recommended that policyholders be returned to the position they would have been in but for regulatory maladministration. The scheme, eventually established in 2010, was capped and paid a proportion of assessed losses rather than the whole. Successive governments faced the same arithmetic. Full restitution would have cost billions of public money for a private failure. Whatever view one takes of that decision, its practical effect was that a substantial part of the loss stayed where it landed, with the members. Now, what a modern insurer does differently, because the industry did learn. Guarantees of this kind are now valued explicitly using market-consistent methods, and the resulting figure appears on the balance sheet whether or not the guarantee currently binds. The regulatory regime requires firms to hold capital against adverse scenarios, not merely against current conditions. Longevity is modeled as a stochastic variable rather than a fixed table, and firms routinely transfer that risk to reinsurers through longevity swaps. None of that machinery existed when the promise was made. All of it exists substantially because this promise was made. That is the genuinely constructive legacy here. The modern discipline of valuing embedded options in insurance contracts, options being exactly what a guaranteed annuity rate is, was driven forward by the recognition that an institution could be destroyed by one that nobody had valued. There is a final detail worth sitting with. The guarantees were not exotic. They were not a derivative, not a structured product, not an instrument invented by clever people to be sold to less clever people. They were a plain sentence in a pension contract written in ordinary English, and their purpose was to protect the customer. Consider how it would have read to someone signing in 1960. A line confirming that whatever happened to the economy over the following 40 years, the rate at which their savings became a pension could not fall below a stated level. For a person who remembered the 1930s, that was not a technicality. It was the whole reason to trust an institution with money they would not see again for decades. The society was not being clever. It was answering the single most reasonable question a saver can ask, which is what happens if things go wrong, and it answered it honestly. The clause existed to make policyholders safer. It was inserted for their benefit, and it did precisely what it was designed to do. It held its value when rates fell. It worked. That is the point. It worked exactly as intended, and the institution could not survive it working. That is a genuinely unsettling thought, and it is not one that appears in most accounts of financial failure, because most financial failures involve somebody doing something wrong. The Equitable Life Assurance Society was 238 years old when it stopped writing new business. It had survived the Napoleonic Wars, the Great Depression, 2 world wars, and the collapse of the empire it had insured. It had invented the actuarial mathematics that the entire industry still uses. And it was undone by one sentence, added when the risk was theoretical, in a decade when nobody could imagine interest rates falling that far or people living that long. It is still in runoff in one form or another to this day. The remaining policies were transferred onward, and the with-profits business wound down decades after the event, still settling obligations entered into before most of the people affected were born. There is one comparison worth making before the conclusion, because it shows how narrow the escape was elsewhere. Scottish Widows, Standard Life, Norwich Union, and several others had written guaranteed annuity rates on similar terms in the same decades. The industry-wide exposure ran into many billions. When rates fell, every one of those firms faced a version of the same bill. They handled it in three ways. Some had simply reserved against it, quietly, over years, treating the guarantee as a liability even while it was dormant. Some had shareholders who absorbed the hit, which is precisely the function shareholder capital performs. And some had been less generous with bonuses along the way, so there was a cushion in the fund itself. Equitable had none of the three. No reserve because the guarantee had been treated as costless. No shareholders because it was a mutual. No cushion because bonus policy had been run to the edge for competitive reasons. Remove any one of those and it probably survives. Remove all three and there is nothing between the liability and the members. That is why this is a story about structure rather than about a clause. The clause was ordinary. The structural position it landed in was not. And it is worth naming the incentive that produced that position because it was not irrationality. Every one of those three choices had a defensible rationale at the time it was made. Not reserving against a dormant guarantee looked like prudence, not recklessness. Reserving against something that had never once bound would have struck a 1970s actuary as needlessly locking up members' money. Mutuality was the society's proudest characteristic and the reason many members had joined. Generous bonuses were how a with-profits fund demonstrated it was serving its members well. Each decision was, in isolation, an expression of the same principle. This money belongs to the members, so give it to them rather than hoarding it. That principle is not wrong. It is arguably what a mutual is for. It simply happened to remove, one by one, every buffer the institution had. That is the pattern worth carrying away, and it is not confined to insurance. Organizations rarely fail because someone decides to take a large risk. They fail because a series of individually reasonable decisions, each justified by a sound principle, collectively remove the slack that would have absorbed a shock nobody predicted. Slack looks like waste right up until the moment it is the only thing that saves you. So, the useful question is not whether an institution is well run today. Equitable was well run for most of its life by careful people using mathematics it had invented itself. The question is what it has promised, to whom on terms that depend on something it does not control, and whether anybody has been made to write that number down. Because the guarantee that destroyed the oldest mutual in the world did not appear anywhere in its accounts for 35 years, and for 34 of them, it was entirely free. One last thought about why this story is so rarely told, given how large it was. There is no villain in it. No arrest, no trial of any individual, no photograph of somebody leaving a building with a box of possessions. The House of Lords ruling is a careful piece of contractual reasoning about the limits of discretionary powers, which is not the stuff of headlines. The loss was spread thinly across 1 million people who mostly absorbed it privately. Financial history remembers the events that had faces. It forgets the ones that had only arithmetic. But the ones with only arithmetic are the ones most likely to happen again, precisely because there is no villain to watch for. You cannot regulate against good intentions, low inflation, and longer lives. You can only insist that somebody, somewhere, is required to write down what a promise might cost, and to keep writing it down in the decades when the answer is zero. And there is a reason that instruction sounds tedious. It is tedious. Writing down a number that has been zero for 30 consecutive years every year feels like bureaucracy for its own sake, and the people doing it will reasonably ask what the point is. The point is that the discipline has to already exist on the day the number stops being zero. An organization that has never calculated a figure does not start calculating it. At the moment, it becomes alarming. It starts arguing about the methodology instead. And by then, the argument is about how large the hole is rather than whether to dig one. Boring measurement, maintained through the decades when it reveals nothing, is the entire defense against this class of failure. There is no clever alternative.